We're recording. Go ahead.
All right. Do you see you on this my screen, or do you see my presentation?
I can see your presentation and me, but in order to just, not bother everybody, I removed me. So now we can see your presentation. Go for it.
Okay, perfect. Okay. Thank you guys for taking time today to be on this call. The reason I wanted to do this call is, well, I had lunch or dinner actually with an agent a few weeks ago, and we were talking about some of the offerings that Golden One has, and she said, oh, you should do a call and go over the stuff. I'm like, yeah, I don't know why I haven't done that yet. So thank you, Miss Jane Heath, for that suggestion. So I've prepared a slideshow here for you guys. As Mike said, I'm not really allowed to send it out because it's guidelines. They can change. It's a compliance thing, all that good stuff. But it's recorded. You guys can take some notes. If you have any questions, email me, text me, call me. I don't expect you guys to remember all of this, but I'm hoping that something that I share with you today will jog your brains for either maybe something in the past, a borrower who you didn't think qualified or maybe didn't qualify. We want to give it another shot, or talking to other agents, you've got this scenario or that scenario, it's not working out somewhere else. So hopefully that's the reason I want to share this with you guys today. Drive some more business. We can do some things that the big banks cannot do or just won't do. Being a credit union, and we do portfolio our jumbo loans, so they're underwritten to Fannie Mae guidelines, but we have a lot of special things that we can do. So here we go. All right, they're riches and niches. All right, so this is just kind of a brief list of what we have. I'm going to go in detail on some of these offerings here in the other slides, but I'm not going to address every single thing on here, otherwise it would take way too long. But here's what we have going on right now. 2 months reserves on jumbo loans. Reserves can come from a retirement account. Most lenders require between 6 and 18 months. We're only 2. Tax returns, do not need them on jumbo loans. Typically, some of the bigger banks will need jumbo loan. They want tax returns, even if you're a W-2 employee on a salary with no bonus, overtime, commission, restricted stock units, all that kind of stuff. But we do not require that. Literally, just the W-2s will suffice. The 80-10-10, for any of you guys who've been on my call before, you've heard me talk about this, and I'll probably talk about it every time I'm on one of these calls with you guys because it's such an amazing product that we have that I have not seen anywhere else. I will go into more detail about this one in the following slides. First, loans. We do have a servicer, Devlin. That is who we use for all of our servicing. They do allow for biweekly payments. You can pay off the mortgage insurance. So if you, maybe you're at 83% debt loan to value, and you've got a little mortgage insurance on there you want to get rid of, you can make some extra payments and get that taken off. There's no minimum requirement that we have for someone to pay mortgage insurance. Some of the banks require at least 2 years. RSU income. Restricted stock units. So this is going to be for your tech clients, right? Google, Apple, Amazon, all of those kind of guys. They offer income in the form of restricted stock units. I'll go into detail about that if you guys have that scenario. Otherwise, it is a little bit. It's not complicated for me, but there's a lot that goes on. Calculating income that you guys don't need to worry about. But what the high level of this is that we use a 2-year average or 36-month vesting, which is a little bit more, even though it says less or up, it's still a little bit more lenient than some of the bigger banks that do allow restricted stock unit income. Forgive me, the vesting, let's see, 52-week low, we just changed that. That's actually the average price over the last 52 weeks of the stock. So that's actually even better because stocks were down last year, but now they've come back up, with a lot of force there. So we're taking the average of it. So that was a deal maker for another loan I had. It basically doubled the amount of restricted stock unit income that I could use when we changed that guideline, and that enabled the borrower to be able to buy the house. He went from like a 58 ratio down to a 36, being able to double that. So if you've got anybody with RSU income, I'm happy to talk to them. It takes me, with the proper documentation, an hour or so to get the income calculated to know if we've got something that we can work with. FICO on jumbo, actually, we are at a 680 on jumbo loans, which is awesome. A lot of lenders are at 700 or even 720 on up. 45 debt to income ratio, we actually can go a little over that depending on the compensating factors, maybe low loan to value, great credit score, lots of reserves, maybe something like that. Let's see, assets for reserves, 401k, stock, retirement. That's pretty common for lenders to use those funds. You might find that they will use 60%, but we'll use 70% of the total assets. We can also, if you've got a borrower who is maybe retired or 62 years or older, we can use asset depletion, which means we can use their assets as income. More on that later. You don't need to concern yourself with all the fine details on it, but if you've got someone like that who maybe their Social Security or pension or something's not quite enough to qualify, but they have significant assets, that's a good phone call to make to me to deep dive into it to see if there's something we can do. 5% down to $1 million, 10% down to $1.5 million, 15% down to $2 million. More on that in the next few slides. For large medical groups like Kaiser, we offer we will allow for Kaiser to gift a portion of the down payment. It would be a third lien. Typically, that kind of situation, the employer will forgive the lien over or the loan over time, so it's not even repaid. Not super common. I don't get this a lot, but if you like I said, these are niche products. If you've got somebody out there that they're like, well, I'm at Kaiser, I'm a doctor, I'm a nurse, whatever, and they're giving me this, and I can't find a lender to help me, give me a call. We do non-permanent resident loans. We're lenient on most visa statuses. I've got some more information on that. Verification of rent, not always required. As a matter of fact, I maybe have had it happen once in the little over a year and a half that I've been here. That can kind of be a sticking point sometimes with big apartment complexes or even individual landlords who won't fill out the form, don't fill it out correctly. It can hold up closings, but we don't request that. The marriage settlement is not always required. We will just take a notarized letter for receipt of alimony as income. Most lenders are at 12 months, but we only ask for 6. Make sense loans considered on exception basis. So another benefit to being here is that Golden One does underwrite more to common sense to offer what our community needs. Given the fact the Bay Area especially is super expensive, and maybe it's the people that want to buy a house, it doesn't fit doesn't tick every box that they have something unique going on, and we'll consider that. So we don't have a hard and fast no on everything. Okay, so if you've got something that's a little bit challenging, give me a call. Of course, this is not necessarily for you guys in regards to your buyers and sellers, but if you do have someone who owns a current home that wants to buy another home, we do investment property, because it would be considered investment if they leave, rent it out. Then we will do cash out up to $250,000 to buy a new home. And we also have investment property home equity line of credit offerings. These are for realtor and lender professionals, okay? So if this is something you want, oh wait, I'm sorry. Nope, I apologize. This is, I think for realtor and lender professionals only was, maybe that's what they were telling me I could give this to you guys. But anyway, so, okay, moving on. So we do have investment property, home equity, or cash out refis. All right, so the biggest one, the one I love the most about being here is the 80-10-10. So I get this call quite a bit, several times, I'd say a week. I get agents calling, asking me a little bit more detail about it. So I thought it'd be important to share kind of a couple of examples with you guys so it can make a little bit more sense. Back in the day, way before the crash, 80-10-10s were super popular, 80-20s. If you were around pre-market meltdown, you knew the 80-20, basically 80% first mortgage, 20% second mortgage, no down payment. Back in the, if you had a heartbeat, you can get a loan days. So we're not back to that. I don't believe we will be, and I think that's a good thing. Give us some more stability here in the market. But we do see the need for a second mortgage to help in some cases. So we offered 80-10-10, 80% first mortgage, 10% second mortgage, 10% down payment. Now, with that said, it is a minimum 10% down payment. But let's say borrower says, well, I want to put down 15%. That's totally fine. We can do an 85-15. So the second mortgage does not have to be 10%. It can be 1 to 10%. Couple examples here. Purchase price, $1.5 million. We would give a $1.2 million first mortgage. That would put us at 80% loan to value. We would give a $150,000 second mortgage, which is that 10% home equity line of credit. And they would be putting $150,000 down. So they're able to buy a home for $1.5 million with only $150,000 down. Example number 2, and this is to help you guys understand that the $1.5 million is the loan amount, not purchase price. Okay, so the loan amount is the max at 1.5. Example number 2, purchase price $1.8 million. Now 1.8 million, and they only have $180,000 to put down. That's doable. We'd give them a first mortgage, 80% at 1.44. Second mortgage, $180,000, $180,000 down. The maximum on the second mortgage is $250,000. So if you look at that, you know, you can see that we can go even over 2 million in purchase price and still make this work. Okay, so this is super popular. I do these quite a bit. Oh, one other piece here. If the borrower does have 20%, because I've had this as well, they can still do the 80-10-10 loan, open up the home equity, then they've got it there. It's a 10-year draw period. It's an interest-only payment. They can pay it off and then just have a home equity line of credit for 10 years. It's a 30-year loan, but they can draw on it for 10 years. It's a way to instantly access the equity. Most lenders are 15% down on jumbo and some are 20, and there's no offering to be able to access any of that equity, not even a home equity line of credit. After closing, they will not go over an 80% loan to value on a home equity line of credit after purchase. So the fact that this is something we can do at purchase is really nice, and it helps. You don't have to worry about opening a line of credit later. Maybe you got kids going to college in about 3 or 4 years, and this is something you can do. Boom, you've got your money there for college if you haven't got it already saved up. Okay. Something else that we do here, I get calls on quite a bit, is it's not technically a bridge loan, but I'm calling it that, and I put it in quotations because if you guys have been doing this for a little while, back in the day, there were bridge loans where, you know, you own a house right now, you want to buy another house, but your equity is in this house. Probably not going to be able to sell it beforehand, or for whatever reason, maybe you want to keep it and rent it out. We will allow for a borrower to pull out as much as $500,000 line of credit. The departing home would be considered investment property, right? If they're going to rent it out, obviously it's investment. If they're going to sell it, it's still going to be investment, but typically that's a short-term loan, even though we don't have a time frame that's got to be paid off. Like, we don't say, well, you're telling us you're going to sell this house, we see it's listed, you know, whatever, you know, you've got 3 months to pay it off, otherwise it's due. It's not a balloon note or anything like that. So this is a very generous offering that we have. If you guys have heard another lender that will do it, let me know. I don't have anybody that I've heard of that that does this. So it definitely sets Golden One apart, and it allows for, you know, it's $500,000 to be used, part or all of the down payment on a new home. In regards to the margin, because people say, well, what's the rate? What's the rate? So the rate is going to be a margin. It's going to be based on the loan to value, the credit score. It's going to be tied to prime. Prime right now is 3.25. Will that go up? I don't know. I mean, maybe, probably, maybe not. I wish I had the answer to that, but it hasn't changed in quite some time. So we watch the Fed for any news of that changing. So it would be, for example, 3.25, maybe this, you know, the margin is 2%. So the rate would be 3.25 prime plus 2%. So we're at 5.25. That would be the interest rate. Now remember, it's investment property. And I've had people say, well, that's really high. Well, it's investment property, right? It's the riskiest of all properties. In a lot of cases, this is going to be a short-term loan. It's, you know, you're going to have your borrower, your client pay it off, you know, 3-4 months or so, maybe even sooner when their property sells. I'd say it's about 80% like that, maybe 20% of the ones that I do, they want to keep their home and rent it out. That's fine, but it is investment property, so that's why the rate's a little bit higher. It's an interest-only payment for 10 years, so it helps dramatically with cash flow. Again, a little higher interest rate, but you're not paying principal unless you want to. There's no requirement that you can't. You can pay down the balance anytime you want. Draw period, like I said, 10 years. It's, like I said, similarly what you guys heard of as a bridge loan. Okay, if it is paid off within 3 years, there is a $500 early closure fee. That is just to recover the cost that it took us to basically process and underwrite the loan. We pay the closing costs on it. So if you pay it off within 3 years, we'd be in the negative. So we that's what the $500 is, subject to change. All right. Now, home equity line of credit, talk about it again, but this is not just for quote unquote the bridge loan, right? We have home equities for primary residence, second home, and investment property. So you've got a person who wants to buy another house. They've got 2 or 3 rental properties, maybe a second home up in Mendocino. They need a home equity. I can do it on that on any of those properties, up to $500,000, 80% loan to value. Investment property might be a little bit less loan to value, maybe 70%. It would depend on the property type, single family home versus condo, that kind of thing. For, let's see an example, all right, your equity in the departing residence, they've got plenty of equity there. They need $500,000, purchase a $2.5 million property. 25% or 20% is your $500,000 from the HELOC, interest only payment, cash flow, you know, it's great. So if you guys have anybody that you think might benefit from this, then let's talk about it. Departing residence, we actually will go to 55% debt to income ratio, depending on the situation here. I won't read all of this to you, but we also do not require the total payment of the departing residence to be used in the qualifying, as long as you've got an executed sales contract, no finance contingencies. So the finance contingencies have been cleared. This does not apply to inspection or due diligence or loan contingent. I'm sorry, appraisal contingency, just finance contingency. We can go up to 55% on that. Just need a 720 or greater credit score, and of course want to stay at 80% loan to value for the departing residents. So if they pulled out money or whatever and they have very little equity in that property, it's going to be a little bit more risky that they could potentially leave. So that's why the 20% equity requirement's there. Let's see. Would not have to do an appraisal on that departing residence. We would just do an automated valuation model there. So don't worry about them having to, you know, pay for an appraisal or anything like that. It's all just done kind of desktop for us. Got a little down here at the bottom, debt to income ratio, PITI, Principal Interest Tax Insurance Association dues, CLTV, just to help you guys kind of understand what some of this lingo is, okay? Okay, rental income. You don't have any history of being a landlord. A lot of lenders will not give you any credit for the rental income on your departing residence, but we will. We will do that with, let's see, we will offset the principal and interest, tax, and insurance. So you're not necessarily getting income over and above what the payment is, but we will offset that payment. So that helps drastically with your debt to income ratio. If someone's got a lease for their home that they're leaving, you know, maybe it starts in 2 months or something, they go out a lease and a copy of the security deposit from the tenant, we can show that that's been deposited into their account and it's cleared, then we can potentially offset that full payment and take it out of the ratios. If they don't own a principal residence and they don't have any housing expense, current housing expense, then we're not going to be able to do it. It's definitely something that they do. You do have to have some history of home ownership to be able to show that you you can handle a mortgage and understand the importance of making those payments on time and all that good stuff. So, but this is pretty strong because a lot of people have this situation where they want to rent their home out, but hitting that payment and the new payment puts their ratios way over, can't do it, but at least we can offset it. Jumbo and super jumbo. So our documented loan amount is up to $5 million. We can go above that if we need to. If you guys have, someone that wants to purchase higher than that with a loan amount, then just let me know and we can send it in for an exception. It's only 5% borrower's own funds contributed to the transaction. We do allow gift funds. If the gifter, the donor, is giving the full 20% down, then the borrower does not have to have the minimum 5% of their own funds. Not super common though. Typically, they're going to have at least 5%. I believe, Mike, you and I had this earlier this year with a borrower who got a gift and he only had to contribute to 5%. Super jumbo is a loan amount over $3 million. It's still only 20% down. A lot of lenders get a little bit squirrely about that. It's a lot of exposure, so they want a lot more money down, sometimes 30 or 40%, but we are only at 20% for super jumbo, and it's only a minimum 700 FICO. We will do investment property jumbo purchase up to $1 million. That's pretty awesome because now's a good time to buy, right? You've got people that have maybe purchased a house a year or two ago, and maybe you want to hit them up and say, hey, rates are really low, even for investment property. Are you interested in building your real estate portfolio? We can do this up to $1 million. Maybe a condo or a townhouse, something like that, is something that they could potentially rent out. Even second home, right? In Mendocino, for example, one of my favorite places, you can buy a home up there for maybe $800,000 or so. Second home, then we can still do that. We do offer interest-only payments for a loan amount up to $2 million. That's also, great cash flow. The rate is phenomenal. I've got a refi in right now for $1.7 million at 2.75. Interest-only payment, 7/1 ARM. So the interest-onlys are going to be adjustable rate mortgage, so fixed for 7 years or 10 years. Still pretty awesome though, if you've got someone concerned about cash flow, or maybe they just want to have a lower payment and maybe put money aside for investment or pay for college or something like that. Like I mentioned, exceptions for increased loan amount can be requested. Will depend on compensating factors, pretty good FICO, maybe extra reserves or something like that. Residency status, we're very lenient on residency status. So if you've got someone who has not been able to qualify with another lender and they're foreign national, permanent resident, whatever, got a work visa, let's talk about it. These are just some scenarios. It's not exact what we do. So if you got something unique, let me know. Just a little bit of documentation. I have had people ask me if we have a higher interest rate based on visa status or residency status, and no, absolutely not. Interest rates are not priced based on that. So your client would get the same interest rate as a U.S. citizen, okay? All right, so on October 21st, Mike and I are gonna host an open house at my office. Golden One just built out the other side of our office in Campbell. Basically doubled our space. We're growing, got a lot more loan officers coming on board. So what I would love for you guys to do is just come out, say hello. You know, we can have chats about scenarios or just get to know each other. You can network with other agents, meet us in person. Light refreshments will be provided. And so you just come with a name tag on and some business cards. And it would be great to really hang out with you guys and get to know each other better. So that's all I have. Didn't want to take up too much of your time. I know you guys want to get out there and pound the pavement. So thank you so much for attending. If you guys want to do a Q&A right now, I'm totally open to it. Mike?
Yeah, there's some Q's already waiting for an A.
All right.
Can you see them or should I read them?
Yeah, I can't. I don't. Well, let's see.
Over there in that little.
Oh, here we go. Yep. All right. Oop, let's see chat. Okay, let's see what we've got here. Okay, I just see my name.
All right. So let me see if I can get a better beat on this. Do you have a Spanish-speaking loan agent? Do you speak Spanish?
Unfortunately, no. I wish I did. No, and I will tell you that you'll find this. You can, if you can find a Spanish-speaking loan agent, great. But all documentation will be in English, and that is true for all lenders. It's a regulation. We can't provide documentation in any other language than English. So, and the borrower has to provide their own interpreter if one is needed. It cannot come from us. Conflict of interest. So. But if you do need one, I'll see if it's someone in my office can speak Spanish. I don't know of anyone offhand.
All right, so here I'm making it bigger so I can, oh, no, it didn't go bigger. Any suggestions or feedback on folks getting out of the forbearance program as of November 2021, but have about significant equity that they want to tap into? Is that possible?
So the way that's looked at, well, first of all, let's talk about what are the lenders going to do when the forbearance period ends. You're going to have three options. You're going to have, well, okay, their lender may say, though, I have 8 options, but the most common ones I see are, 1, you can pay the arrears in full if you'd like. Probably not going to happen, right? Otherwise, you probably wouldn't have been in forbearance, but it is there. So pay the arrears in full. They're offering, some lenders are offering to put basically, not really call it a second mortgage, but take the arrears and put it on the back end of the loan. So let's say you're in arrears of $100,000 and you owe $700,000 on your home. What they'll do is allow that $100,000 to go at the end of the loan so that when you pay it off, sell it, refinance it, that will be paid off then. No interest is supposed to accrue over and above what it already has for that particular amount of money. So just make sure if you're going through that yourself or you've got somebody that is, make sure that they read the fine print, make sure their lender doesn't have anything in there where they're charging any more interest. Or you can do a modification where you would take that $100,000 and over a course of, however many years the lender will allow, you can make extra payments per month. So maybe $500 more a month or $1,000 more a month or whatever. They'll let you do that until the arrears have been paid off. Now, I'm assuming the question is also, will they be able to do a cash out refinance, right? Or home equity on that property? Home equity, most likely. Cash out refinance, sure, but we're going to pay that arrears off in the loan. So the new loan would be for example, the $800,000 instead of $700 plus whatever cash out you were getting.
So there's a question, where can I get more details about loans for foreigners or the visa status? I texted everybody Jody's contact information. I think the answer is reach out to you. Is that the answer to that?
Yes.
Yeah.
Yes, reach out to me because it's basically a case by case basis. But again, we're very lenient, so definitely give me a call.
Jane is asking about co-op lending, and then refers a condo in Redwood City. Do you mean a condominium or do you mean a co-op? You know, that'd be a question, but you know, a co-op. I don't know.
Co-op, we don't do have lending for co-ops. Most lenders don't. I'm trying to remember who does. I want to say Fremont Bank, but I could be totally wrong. But you can Google co-op lenders and find one online, but you're not going to really find that much with the big banks and even.
And my experience has been like in San Francisco, there are a lot more of them, the co-ops, tenancy in common ownership. A lot of times there's already a loan against the co-op has. And many times you're buying into the existing co-op lender's loan on the co-op, because in a co-op, you don't own the unit, right? Not like a condo, right? Or a townhome where you actually own something. In a co-op, you have an interest in the whole thing, tenancy in common, and then they assign you a unit. So usually if you ask the co-op, who's the lender, you know, they'll tell you this is the lender. Sometimes you have to use that lender. Otherwise, all of the big co-op lenders are located back east in New York and things like that, because that's way more common back there.
Right.
Sorry about that, I just, you know, thought I would. So what, call, email, or text, what's the best way to reach you, Jody?
Quickly is text, because I tend to be on the phone a lot. So if you text me and I'm on the phone, I'll just say, hey, you know, call you right back. So text me if you want to talk and set up time, or if I'm not on the call, then I can call you right away.
And then there's a question, thank you for that. Do you finance raw land?
We do, not very, very, very common, up to 25 acres. So just give me a call.
What's the loan to value ratio on that?
You know, I actually had my guidelines up earlier when I saw that, but it didn't tell me. So just give me a call and we'll talk about it.
Right, it's usually very low.
Yeah.
For raw land, it's usually very, very low. We're not talking like 80%. It might be 40% or something. It's usually very, very low. Unless entitlements have already been approved for the property, and you're looking and you have a construction project and you have a buyer for the project, at which point you can get 100% financing on the land, but that's only because it's part of a bigger deal and there's a takeout lender coming down the pike. Anyhow, have we missed any? I think we've got them all. Oh, what is Golden One's geographic reach? Just Northern California? Oh, no.
It's the entire state of California.
Yeah. All right. Any other questions? Anybody's got there? I don't think so, unless I just missed something.
Okay.
All right.
Well, I'm around all day, so feel free to call me, and let's hopefully you guys will come out to the open house. I'll send an actual invite out later, so don't feel like you have to, like, this is the only information you're getting. I'll send an invite out to it, and it will be, you will need to RSVP. I want to say that because the space is limited. I'm not just saying that. I would imagine we could probably fit around 40 or so comfortably. But hey, if we've got more than that, we'll spill over into the prune yard and maybe go to Orchard City and have a nice tall glass of wine or whatever.
Now there's gonna be like 100 people showing up. All right.
I know, if you stop recording.